Good afternoon and welcome to part 2 in our second series of Let's Talk Poultry. My name is Rebecca Tierney, Poultry Advisor with Teagasc. This series has been developed for you, our poultry producers and industry stakeholders. The title and speakers have all been chosen from your feedback and the requests you gave us, so thank you. Today I am delighted to be joined by Ciaran McCabe, Poultry Specialist with Ifac. Ifac, or Irish Farm Accounts Co-op, is an accountancy firm which was formed over 40 years ago by farmers for farmers. Since their inception, the firm has grown considerably. Today, it is the 9th largest firm in the country by turnover and largest by client numbers, with over 19,000 clients nationwide, operating from 27 different locations around the country. Ciaran McCabe, a native of County Monaghan and a part-time farmer himself, qualified as a chartered accountant and auditor in 2007. Ciaran joined Ifac Monaghan in 2014 and quickly rose to become a partner by 2017. Having spent 19 years working as an accountant in County Monaghan, this has allowed Ciaran to gain vast insight and knowledge of the poultry industry and tailor the tax needs required for all poultry farmers. Today is an opportunity for you to ask Ciaran any questions you may have, so I want to draw your attention to the Q&A tab at the bottom of your screen and invite you to send in any questions for Ciaran. We'll answer these at the end of Ciaran's presentation. Today's webinar will be recorded and will be available along with Ciaran's presentation to view on the Teagasc website after today. So Ciaran, I'd ask you to turn on your camera and to share your screen and we'll get started.
Thanks, Rebecca. First of all, I'd like to thank Rebecca and Teagasc for inviting myself along here today to talk to yourselves. I'm just going to share the screen here and stick up this presentation. So basically, we are going to split the presentation into 4 different areas. We only have about 40 to 50 minutes to speak, so we're going to be able to touch on certain areas, but reality with the time we have, we're not going to be able to get into certain areas in depth. Q&A section at the end. Aside from that, I'm going to put up my phone number and email address at the end, and if anyone has any queries, feel free to give us a shout after the presentation or in the weeks to come. I suppose the 4 sections we're going to look at, we're going to take a quick look at Ifac and Poultry. We are going to take a look at climate change tax incentives, mainly accelerated capital allowances. Take a revisit the basics of income tax, and then look at structures, whether that be sole trader, partnerships or limited company. Ifac and poultry sector. Currently, there's about 610 producers in the country, 370 involved in broiler production and about 240 involved in egg production. It has been a growing sector over the last number of years. For example, 31% increase in laying hens from 2010 to 2016, and 2018 saw 70 new planning permissions lodged at county councils around the country for poultry houses alone. This has been despite, I suppose, a large capital investment. It has been encouraged by the processors themselves. It's been encouraged by the banking sector, as they have seen the poultry industry as a safe bet, given the profits that have been generated over the last number of years. With Ifac and Cavan Monaghan area here, we've got 180 poultry clients and an additional client base then around Waterford, Cork and Limerick area. As we said, there's been a growing sector for the last number of years. However, the last 18 months has seen processors apply the brakes somewhat and cut back, I suppose, on the expansion and put a halt to expanding with new houses. And I suppose come to terms with, I suppose, the expansion that have done over the last number of years. Most processors seem to be operating almost at full capacity at the minute. So for any further expansion in the industry will require the processors to expand as well, probably. A couple of figures here. These have just a random sample have been taken on the broilers there. There's about 60 houses have been surveyed. The average turnover there was 443,000, feed cost 358, net profit of 41,000. Now, again, this is a random sample of 60 poultry houses in the broiler sector. Lowest profit was at 22,000 per house. The highest one will be 64,000 per house in that sample. Now, the houses at the 22,000 per house were where 30 to 40-year-old houses operating, let's say 15 to 20,000 boards, and the profits increase obviously as you go up the scale. But realistically, for your modern day 50,000 board house operating at full capacity at seven batches per year, you would expect that house to be generating about 100,000 profit. Similarly, with a 40,000 board house operating at 7 batches per year, you'd expect a profit of about 80,000 per annum. On the egg side, again, there was a sample taken. Average turnover was 176, average net profit at 29,000. Lowest in the sample was 15,000, the highest is 72. Again, this is a mixture of laying houses. Some of them are old caged houses, some small 3,000 board houses, and more modern houses as well. Again, looking at the more modern day house, the 12,000 free range board house, you should expect to generate a profit of roughly 100,000 per annum. Your 3,000 free range organic house, maybe a profit around 57,000 per annum. Climate change and tax incentives. The main one to look at here is the accelerated capital allowances on energy efficient equipment. That can be extended to sole traders, partnerships and companies since January 2017. However, it's due to expire at the end of 2020. You must carry out a trade to use the equipment for the trading purposes. For example, if you put solar panels on your dwelling house, obviously they're not allowable. If your solar panels on the poultry house, they are allowable. The relief does not apply where the equipment is leased, let, or hired to any person and must be used within the trade that you're carrying out. So what are accelerated capital allowances? Under normal circumstances, capital allowances are the tax relief on capital investment, I suppose, on the farm. On a building is wrote off at 15% per annum. On plant and machinery is wrote off at 12.5% per annum. So on a spend of 100,000, you get 15,000 a year off your tax or against your profit on it, and that's fixed. And anything that's not fixed, you'd be looking at 12.5% or 12,500 on 100,000 spend. The accelerated capital allowances will allow you to write off 100% of that investment in year one. So the full 100,000 will be allowed to write off against your profits in the year one. So bringing forward that tax relief and using it all immediately. If you didn't have, for example, if let's say your investment of 100,000 and you only had profit of 80, that excess of 20 can be used then in year two. To qualify, the equipment must meet certain energy efficient criteria, must be specified on a list of approved products. The SEAI, or Sustainable Energy Authority Ireland, is responsible for maintaining the list of equipment, and it falls into different categories. The main ones, I suppose, the poultry sector we'll be looking at is lighting, heating, and electricity provision. There is a minimum level of investment. However, anyone spending money in a poultry house will easily meet this minimum level of investment. For example, on the lighting side of things, let's say you're putting LED lights into the poultry house, the minimum investment is €3,000. On the heating side of things, the minimum investment is €1,000 to qualify. So as I said, the poultry sector will easily hit those minimums if they start to spend a few pounds on the poultry houses. To satisfy the criteria, the equipment must be new equipment. It must be acquired and used for the purposes of the trade. It must be in use by the end of the accounting year, the accounting period. So if let's say you had bought the lights in 2020 and your year end was the 31st December 2020, having bought the lights isn't enough. They must be fitted and usable by the end of the year for you to claim the relief in that year. How do you know you qualify? Well, you need to check the list with SEAI to be 100% sure. However, most items that qualify for TAMS grant will also qualify for the accelerated capital allowances. But again, to be 100% sure, it would be advisable for you to check the SEAI approved list. Income tax and revisiting the basics on that side of things. So income tax rates currently in Ireland are 20% and 40%. The tax bands for a single person can earn up to 35,300 per annum, at the 20% band. If you have a married couple with one spouse working, they can earn 44,300. However, if both spouses are working, they can earn up to a maximum of 70,600. So, for example, if we had a broiler grower or a free-range hen grower whose spouse wasn't working off farm, perhaps you might form a partnership and then bring in that second 20% band. Similarly, if they were operating out of a company, both spouses can take a salary from the company, accessing that 70,600 band. The tax credits for 2020 for a single person is 1,650. A married couple can get 3,300, and the earned income credit is 1,500. And PRSI for self-employed people is at 4% on all income. Now, all of those rates and all of those tax bands and tax credits have remained unchanged for 2021, with the exception of the earned income credit, which has been increased to 1,650 for the 2021. Universal social charge. This was a nice wee tax that was brought in during the recession, and it's responsible for a couple of grand at the bottom of everyone's tax bill most years. If you're earning below 13,000 a year, you're exempt from paying universal social charge. If your earnings are above 13,000, you're taxed at 0.5% on the first 12,000 a year. You're taxed at 2% on your earnings between 12 and 20,000. 4.5% between 20 and 70,000, 8% on between 70 and 100,000, and for anyone who's self-employed, if your earnings go over 100,000, you're paying 11% universal social charge on your income. That's over 100,000. Just jumping forward a couple of slides here. So effectively, that means the low rate of tax is not in fact 20%, it's 28.5%. So you have your 20% tax, your 4% PRSI, and your 4.5%, let's say your middle rate universal social charge at that level. Once you hit into the high rate of tax, up to 70,044 euro, it's bringing you to 48.5%. So your 40% tax, and again your 4% PRSI and 4.5% USC. Once you cross that 72%, the USC rate goes up, bringing you up to 52%. And once you cross that 100,000, you're up to 55%. So most poultry growers with more than one house, with more than one poultry house, would be hitting up at that 100,000 or above it and end up paying 55% tax potentially in their own name. A couple of other wee bits there on income tax. Family wages, if you have kids who work on the farm, they can earn up to 15,000 a year without paying tax. If you're a sole trader, partnership, or company, they can work for each of those entities. However, you must register as an employer and put them through the payroll system. You can't just pay them the money and expect for them to get it tax-free. They have to be registered as employees. Their tax credits have to be assigned to you as their employer. They have to be paid on weekly or monthly or whatever basis it may be. The money must be paid to them, and it has to go through the payroll system. Land leasing there, a tax-free income up to 40,000 per annum. It's not one that's really used that often in poultry houses, as most poultry houses are not rented out. The land leasing exemption includes farm buildings and therefore includes poultry houses. So if you're renting your poultry house to a third party outside your immediate family, if you put in a long-term lease of a minimum from let's say 5 to 7 years, you can get 18,000 per annum tax-free. Between 7 to 10 years, you can get 22,500 tax-free. Between 10 to 15 years, you can get 30,000 of rent tax-free, or if you lease it up for 15 years plus, you can get 40,000 per annum tax-free. So you can't lease it to a sibling, you can't lease it to a child, you can't lease it to your own company or a company owned by your child. It has to be an independent third party, or you could, let's say, lease it to a niece or nephew, which are slightly further out in a relationship. The succession tax credit there is 5,000 per annum of a tax credit for 5 years. We'll touch on that a wee bit later when we move to look at partnerships. So looking at farm structures here, there's essentially three farm structures that you can operate in Ireland. There's three principles: sole trader, your partnership. Under partnership, then you have a registered farm partnership, you have a non-registered farm partnership, and you have a succession registered farm partnership, and then you have a limited company as well. Your sole trader is the most common. It's less legalistic. It's the easiest to operate. It's basically yourself in your individual name. You register with the revenue commissioners for income tax, you open a bank account, and off you go, essentially. The taxes that are involved there are your income tax at whatever level your income falls into. As we said, if you're the low rate tax, you're looking at about 28.5%. If you're in the high rate tax, you're looking at an average of 50%. Your capital taxes, access to the normal rules for capital gains tax, capital acquisitions tax, etc. There's a volatility measure there that can be accessed called income averaging. That's more prevalent in the dairy and beef sector where profits are up and down depending on given years. However, for the last number of years, poultry has been quite steady, so income averaging wouldn't be that common in the poultry sector. And sole trader is available to everyone and anyone. Partnerships then, we have a registered farm partnership and non-registered farm partnerships. So a non-registered farm partnership, again, very simple to set up. You have registration with the revenue commissioners and open up your joint bank account, and essentially off you go again. With the difference in it and a registered farm partnership is a registered farm partnership is registered with the Department of Agriculture. You have partnership agreements in place. There's legal agreements in place there as well. Each partner in both scenarios are taxed on their share of the income. So it's up to the partners to decide at the outset of what way those profits are going to be split. It can be 50-50, 80-20, 60-40, or whatever ratio you decide to go on. Income volatility there and averaging, income averaging again is available to the partners if they so wish to avail of it. It's basically the same tax position as a sole trader. You'll have an extra tax return next 2 tax returns to file. Both partners will have a tax return each to file in their own name, and then the partnership itself will have a tax return to file. However, there's no tax to pay on the partnership return. It's basically an informational document that goes to the revenue commissioners. The tax is actually paid on the individual partners' returns themselves. So what would be the benefit of a registered farm partnership? Stock relief is at 50%. Again, not really that relevant to the poultry sector. Your BPS benefits for the single farm payment or the basic payment scheme, a young trained farmer can get €64 per hectare up to a maximum of 50 hectares. So the poultry, the one area here in the registered farm partnership that the poultry industry would be interested in is the grants, or the TAMS grants that can be accessed. As an individual in your own name, a farmer can access 40% of 80,000. On a spend of 80,000, a young trained farmer can access 60% of a spend of 80,000. But in a registered farm partnership where you have a young farmer and an existing farmer, they can access 60% on 80,000 and 40% of 80,000 on the same spend. So effectively, you potentially get €80,000 back on a spend of 160,000. Succession farm partnerships, these came into effect in 2017. It was thought that there was going to be a big uptake on them. However, realistically, there was very little uptake on them, and it was down to the legal profession and their I suppose, the unwillingness, rather rightly or wrongly, to proceed with it. It was to encourage transfers to the next generation. By signing up to a succession registered farm partnership, number one, you have to be in a registered farm partnership for at least a day, and then you proceed on to a succession farm partnership. you get an extra tax credit of 5,000 per annum for 5 years. So that's essentially 25,000 euro off your tax bill over a 5-year period. And it's split in line with the profit sharing ratio. So if one partner has 80% of the profits, well, then he's 80% of the 5,000 euro tax credit. Doesn't apply to companies, and once the young trained farmer reaches 40 years of age, it ceases. So if they only went into it 3 years prior to his 40th birthday, he'd only get the 15,000 as opposed to the 25. The biggest problem with them is that to access or get the extra 5,000 euro tax credit per annum, the existing farmer who owns the assets must sign a legal agreement whereby he legally agrees to transfer a minimum of 80% of the farm assets to the young trained farmer between years 3 and years 10 of the partnership. Now, this is where they've been running into problems, because guys have been going to their solicitors and saying we want to do this legal agreement, and on the solicitor's advice, it basically gets halted there, because the solicitor are very unwilling to put someone into a legal agreement whereby, let's say, in 7 years' time, they have to transfer 80% of their assets to somebody, when a lot can happen between now and 7 years' time. If you went into a succession farm partnership and you failed to adhere to the criteria and transfer the 80%, within the 10 years, the gain of the tax credits got is clawed back. If the existing farmer who owns the assets, if he refuses to transfer them, it's his tax credits that are clawed back. However, if it's the younger generation, the young trained farmer who refuses to take the asset or doesn't want the asset anymore, it's his portion of the tax credits that are clawed back. Suppose just before we move on to companies, looking at the partnerships there, one thing that's becoming more popular in the poultry industry this last while, it has been popular in dairy sector particularly, is a partnership with a company in it as a member or as a partner. Why would you do that? I suppose there's certain circumstances. For example, if an individual or young trained farmer inherited an asset and claimed agricultural relief against his inheritance tax, supposed to avoid paying capital acquisitions tax of 33%, part of that condition is that he must farm the asset for 6 years. Again, if he's a young trained farmer and has availed of the stamp duty relief at 0%, part of the conditions is that he must farm the asset for 6 years. Other scenarios would maybe involve VAT on new buildings and bits like that. So maybe the individual is farming the poultry houses, earning an excessive profit, very few capital allowances left, needs to be in a company because he's paying excessive tax, but can't move for the next maybe 4 years, because if he does move, let's say, into a company, he personally is no longer farming the asset, and therefore may have a clawback on his capital acquisitions tax or his inheritance tax. So an option would be there is to form a partnership and bring a company in as a partner, possibly owned by, the company may possibly be owned by his spouse. A portion of the profits then will be moved into the company, where they would avail of 12.5% tax. The individual as a partner in the partnership would still satisfy the criteria of farming the asset for the 6 years until the 6 years are up. Once the 6 years are up, the ultimate goal would be to move 100% of the trade into the company and cease the partnership. But if there's a time lag or a number of years there where somebody is going to suffer excessive tax for a period of time, this is a scenario that may help the situation. Now, it's a fairly complex one. You'd have income tax returns to do for the individual partner. You'll have a set of partnership accounts to do. You'll have a partnership tax return to do. You'll have a set of company accounts to do, which have to be supplied to the company registration office. and you'll have corporation tax to pay in the company, and you'll have income tax to pay on the individual's portion of the earnings as well. So there's a lot in there. It's fairly complex, but if it's going to save a considerable amount of tax, it may outweigh the disadvantages and the cost involved in it. So the next step up there is limited companies. It's a step up in complexity. It helps if you're familiar with the runnings of a company. We would find that anyone that moves to a company, it takes them at least 12 to 18 months to settle in, to settle into the running of a company and getting used to dealing with the certain issues. So in a company, you obviously have to have a shareholder. You have to have a company director and a company secretary. You're dealing with company law. If you own more than 15% of the company, you are a proprietary director and still must file an income tax return. Your company will have a corporation tax return to do, and then you'll have to look at capital taxes moving in and moving out of the company. The corporation tax is obviously widely known at 12.5%, which is a considerable advantage versus the average of 50% rate in your own name. So on the large scale, benefits outweigh the disadvantages to moving into a company. So who does a company suit? So a developed farmer with high tax. So let's say a poultry farmer who has his poultry houses built. He's not going to build any more. All of the tax relief has been used up, or the capital allowances has been used up on the existing poultry houses, and all of a sudden he's going to find himself in a fairly high tax position. Developing farmers with high investment or borrowing requirement, or farmers with high borrowings. So take, for example, we talked there a few minutes ago about someone earning 100,000 or over 100,000 will be taxed at 55%. So that individual, if they want to pay €1,000 to the bank, paying tax at 55%, they must earn €2,222. So to give the bank €1,000 in repayments, they have to earn €2,222. That's €1,222 in tax to the revenue to leave them with €1,000 to make repayments on a loan. If the same individual earning the same money is operating through a company, that company must earn €1,143 to pay €1,000 to the bank. That's €1,000 to the bank and €143 in tax. So you're looking at €143 versus 1,222 in the difference in the two tax bills. It's €1,079 of a difference for every €1,000 you must pay to the bank. To put that in context here, take a loan at 500,000 at 3.25% over 10 years. The repayments would be 58,600 a year. For the individual to pay that 58,000 to the bank at the 55% tax rate, he needs to earn about 130,000, whereas the company only needs to earn 67,000. So that's a saving of 63,000 per annum, which is a considerable saving. So again, it also suits farmers looking to create wealth. If you're not paying tax, that money that's being earned is being built up in the company, sitting in the company account. It's available for reinvestment in the farm, or to take out for yourself. Sorry, just give me a sec. It also suits farmers with low drawings, outside debt requirements. Again, take a farmer earning 100,000. If he needs 35,000 to live on, if he's earning that 100,000 in his own name, when you take into account his 20% tax, his 40% tax, his PRSI and his USC, his tax bill would equate to 38,600, despite him only needing 35,000 to live on. If the same individual was operating through a company and the company was earning 100,000 and he needed 35,000 to live on, he could take his 35,000 out of the company at a 20% tax rate, paying his USC and his PRSI would end up costing him 6,200 in tax. The remaining 64,700 will be taxable at 12.5% of the company, leaving him paying corporation tax of 8,000. So total tax bill in the company between personal tax and corporation of 14,300 versus 38,000 in his own name. So that's a saving of 24,000 a year. Or an individual earning 100,000 but only needing 35,000 to live on. Now, companies aren't suited to everyone due to their complexity. Someone looking to retire within the next 10 years, it may not suit because you need to be in the company 10 years to get back out of it tax-free. And there's other issues there that need to be looked at as well if you consider moving to a company. So how do we extract cash from a company? Director's loan, if you transfer assets to a company, you effectively have sold that asset to the company and the company owes you the money for it. Again, take a poultry house worth 500,000. It cost you 500,000 to build it. If you sell that poultry house to your company for 500,000, there's no capital gain. So there's no capital gains tax, but the company owes you 500,000 for that poultry house. Effectively, in this scenario, we would look at maxing out the client's 20% band, maybe him and his spouse taking 70,000 a year out of 20%. Anything over above that he wants to take out taxable at the high rate of tax, we would take out through his director's loan and effectively pay 0% tax on it. The fly in the ointment here is stamp duty. So up until about 3 years ago, stamp duty was at 2%. It is now currently at 7.5% and is rumoured to be moving to 9% in the near future. But again, that's not confirmed. On a poultry house at 500,000, 7.5% stamp duty is 37,500. Sounds like a sizable amount of money, but in reality, it's 7.5% on 500,000 versus an average rate of 50% in your own name over a period of time. So it's still a good investment. This will allow you to withdraw funds from the company over a period of time. Your salary, taking money out of the company versus through salary and rent dividends. So as we said earlier on, you'd max out your 20% band through your salary at 35 or 70,000, depending on your situation. Rent can be also another income stream from the company. So if you don't transfer the poultry house to the company, you'll have to personally rent the poultry house to the company so the company may use it. Similarly with free range growers, in a lot of cases, if they do transfer the poultry house in, they'll transfer the poultry house plus maybe the footprint of the yard, but they retain the free range area of the land in their own name, and that land will then be rented to the company. Expenses incurred by you on behalf of the company can be claimed back tax-free. So pre-COVID, this meeting would probably be happening maybe in Ballyhaise or somewhere like that, and you could possibly claim mileage for travelling to and from the meeting on behalf of the company. So the first 1,500 kilometres, for example, in a year, you can take out 45 cents per kilometre. The next 5,500 can be taken out at 84 cents per kilometre. Also, if you're away from your place of business, as in the yard, for more than 5 hours in a day, for example, travelling to a meeting, you're entitled to a meal that day as well. Another method there of extracting cash from a company is share buyback. So if you had cash reserves built up in the company and you're passing the trade on to the next generation, the company can buy back your shares and issue new shares to the next generation. That would be liable to capital gains tax at 33%, but again, it's still preferable to an average rate of 50% income tax. Need to watch out for a trade benefit test here. So the share buyback must benefit the trade as part of tax legislation. However, it is deemed that if someone was retiring to make way for the next generation, this is to benefit the trade, as it will prolong the trade into the future. If, for example, you are going to retire and you don't have anyone coming on behind you, an option you would have available there is to wind up the company, again liable to capital gains tax at 33%. However, there are possible reliefs there, like retirement relief and entrepreneur relief. What entrepreneur relief does is it reduces the corporation tax, the capital gains tax rate from 33% down to 10%. So effectively, you would pay 10% on the gain when winding up the company, as opposed to 33. Again, even at 33, it's preferable than the average rate of 50, and at 10% is definitely preferable. Another option you have available there to you is retirement relief. So if a shareholder has been trading the company and owns the shares for a period in excess of 10 years, it's over 55 years of age, and decides to sell his shares or wind up the company and dissolve the company, he can extract €750,000 from the company tax-free, provided he does it between the ages of 55 and 66. If he waits till after 66, that threshold drops to $500,000 as opposed to the 750,000 at the lower age limit. If you have, for example, a couple or two spouses who own shares in the company, that's the double threshold, so they can each take out 750,000, which is €1.5 million, if the assets and income is there built up. If they leave it to after 66, obviously that drops to €1 million. Potential issues, one that's quite topical there at the minute is farm buildings at present are not rateable, as in commercial rates payable to your local county council. However, with the addition of solar panels, it's been debated, how much energy are these solar panels generating and how much is being sold back into the grid. Could it be deemed that these solar panels are a separate trade to the farm, as in it's a separate strain of income, depending on the level of income that's going to be there, how much is being sold into the grid, how many solar panels are there? Could this separate trade then become rateable, and therefore turn your farm building into a rateable building? It's one thing that has popped up a few times recently. If you come across it, you should liaise with your local farm reps. Don't run off and highlight it with the local authority, and ensure the issue is handled properly. So companies, you must remember that it's a separate legal entity. The company owns the assets, so any assets that you transfer in the company owns it. So if you for example, transfer in a plot of land, and a number of years' time want to give a child a site, if the company has to give the child the site, not you, and there could be tax implications there. Only retained profits, as in profits that are held in the company, are taxed at 12.5%. So the example we used earlier on, if someone earned 100,000 and taken out 35,300, it was the 64,700 that was left in the company that's taxable at 12.5%, not the full 100,000. Winding up the company can be complex, but is normally beneficial. The income averaging aspect of things, which isn't applicable in companies. Company can now qualify as a lessee. So previously, with the long-term lease exemption from tax, a company could not qualify as a lessee. Now it can, and the company is the same as an individual in their own name. They can earn the flat rate farmer status for VAT. They can claim VAT on a VAT 58 on capital expenditure, etc. I suppose that brings us to a close on the slides. You have my email address there and phone number. We can open up, I suppose, a few questions from the floor if needs be. If anyone has any, if anyone wants to contact me afterwards via phone or email, we'll endeavour to get back to you as quick as possible and sort out your query.
That's great. Thanks a million, Ciaran. I might get you to just unshare your screen there, if you don't mind. A lot of detail there, and definitely a lot covered. So yeah, look at I have your details as well if anyone missed them. But as I said, this presentation will be available on the website after. So yeah, we have time for a few quick questions there, Ciaran. So We have a question in here. When leasing poultry houses, does the leasee have to use the property for farming purposes for the leaser to avail of the tax break?
Yes.
Okay.
Simple answer. Simple
Yep.
answer.
Straightforward. That was a good start. So, so in terms of setting up as a limited company, if there's any new or potential poultry growers on the webinar there today, is it best that they set up as a limited company for starting off, or would you recommend them starting as a sole trader if it takes that little bit of time to get used to? Would it be better starting as a company to begin with and avail of all those
it's
tax
generally it's generally easier to do it day one, and the banks prefer you to do it day one, because obviously you've seen the difference there in repayment capacity on €1,000. And we talked about anyone at 55% tax will have to pay 1,200 of tax along with the €1,000 bank repayment, versus a company 143 plus 1,000. Now, for the first 7 years of trade, if you're going into poultry and you've built a new poultry house, you should be somewhat sheltered from the tax relief on the house. The problem will come in year 7 and 8, where your tax relief all of a sudden has run out, and you've basically gone from paying very little tax, if any tax, to possibly 30,000 of tax in the space of 12 months. At that point, if you want to move to a company, you would have to go back to your bank. You'll have to get the bank's permission. You'll have to get new borrowings issued in your new company. You will have to get the bank solicitor to lift their security, transfer the poultry house in, pay your stamp duty at 7.5%. So it gets a lot more complex towards the tail end of that 10-year period. If you want to go to a company later on, if you're a new poultry grower starting out, it's far easier to transfer your site in at the start, build your poultry house in the company. Banks prefer it because they see the company can retain more profit and basically leave it easier to repay the loan for them and that aspect of it.
Okay, perfect. So yeah, it would definitely, from that, it definitely does make sense to do it from day one. How long would it take for that process? So if someone's at the stage they've got their plan, and how long does it take to become a registered company, or how long should someone allow for that process?
The setting up of the company is not the problem. You could set at a push. You could have a company set up within a week. Generally, you could have the company set up within a fortnight, between to and fro with company registration office with paperwork here and there. The slowdown in the process comes after that, when you come to going to set up a bank account for the company. Both directors and secretaries have to present themselves to the bank and make an appointment. Then you have the issue of your site. So the bank won't let you draw down your loan for the construction unless the company owns the underlying area, as in the site that the poultry house is going to be built on. So then you have to go to a solicitor and get the site transferred in. So that may take some time, because they'll have to check rights of ways, boundaries. You might have to map off the site. So the actual physical setting up of the company won't delay you that much. It's the process with solicitors transferring the site in and possibly setting up a bank account with the bank that might slow the thing down a wee bit.
Okay, perfect. And you mentioned there about having the company owners and who's involved. Obviously, a sole trader is just one. A partnership is two or more. How many people needs to be registered as employees or stakeholders?
With a company, you need one shareholder, minimum of one shareholder, and you need one director and one secretary. So you need 2 names. Now, both parties don't need to take a salary out of it.
Okay.
They don't have to be registered as employees. Neither party can take a salary out of it if they require. If you want to leave all the money in there and you have separate money to live on, that's fair enough. But you need one director and one secretary, and either one of those can be the shareholder as well.
Okay, so a minimum of 2, and you can keep going. So a couple, a married couple, or father-son operation.
Yes, someone you trust.
Someone you trust, very important. Yes, definitely. So just on the accelerated capital allowance, you mentioned TAMS grants. Is there any effect on those, or the likes of the SSRH there, in terms of the renewable heat scheme? How does the two go hand in hand? Can you claim both?
The two more or less go hand in hand. Most items that qualify for the TAMS scheme and the SRH will qualify for the accelerated capital allowances.
Okay, perfect. And just on your tax band, I know for the bank, if you're looking for a loan, they take into consideration dependents. So if a married couple has kids or that doesn't have any effect on tax rates or tax bands?
If one spouse is at home and isn't earning money, they can claim a carer's allowance or carer's tax credit. But other than that, it's not the tax band itself doesn't get affected.
Doesn't get affected. Okay, perfect. I think just you just mentioned there on the solar panels. Has that changed that energy can be sold back to the grid?
No, it's just a couple of issues that have come up recently. It's been debated. It's not necessarily come into effect. I was just kind of highlighting it to say if anyone else comes across it to make sure that it's dealt with properly.
Okay, perfect. No, that's okay. I think that definitely covers. That basically covers, I think, all the questions there. Look, thanks a million, Ciaran. I know you're absolutely up to your eyes there at work at the moment, so I really appreciate you taking the time to join us today.
No problem.
It's great to draw our attention to these people's. Just one last question after popping in there. The difference in accountancy costs in terms of registering as a sole trader or as a company.
Yeah, well, so obviously, as you go up the scale, you have a sole trader there. It's a simple procedure: a set of accounts, one tax return. You go to a partnership, you'll have a set of accounts and possibly 3 tax returns. If you go to a company, you'll have to submit your accounts to the company's registration office. You have to apply to company law. You'll have to file a return to the company's registration office as well. You'll have AGM minutes to do. There's a wee bit more complex and more work to be done in it. Look, it is more costly to do it. It can depend on the system. To be fair, on broiler and laying outfits, as in an egg situation, the accounts are a lot more, I suppose, are easier done than the likes of, let's say, a dairy or beef or anything like that, because even I suppose from the broiler point of view, a lot of the expenses are already paid out through let's say a co-op structure or something like that. It is a bit more expensive. It can depend on the situation. You're probably looking anywhere in the region of maybe €1,000 to €2,000 more per annum to do your company accounts. You still have an income tax return to file yourself as well as the company tax return. It is a wee bit more expensive, but the benefits outweigh the additional costs effectively, tax-wise.
Okay, perfect. So again, thanks a million, Ciaran, for joining us today. I know you're just up to your eyes with the time of year that it is. I really do appreciate it. It's really good to draw the attention to the poultry producers and potentially new producers to maybe take the initiative and join as a company to begin with. So I want to thank everyone for joining me here today and for all your great questions. A reminder that our next webinar will be on December 16th at the usual time of 12 o'clock, where I'll be joined by Michelle Burke, Senior Poultry Nutritionist with Devonish. Michelle is going to talk to us on poultry nutrition and protein sustainability, which is something that will be of utmost importance as we challenge climate change and things like that. So that's all from me here today. Thanks for listening and see you all soon. Stay safe and thanks again, Ciaran.
Thank you.